Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss what zero-dated options are and how traders are leveraging them. Steve, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much, Jill. Always a pleasure.
You got it. Let's start with the basics here. What are zero-dated options?
Zero-dated options are options that expire that afternoon, or sometimes it could be extended to things that expire tomorrow, even though technically there's 1 day left till expiration. But what's happened is we've been evolving toward ever shorter expiration cycles since the industry started. We went from, when I started, we had quarterly expirations and monthly expirations, and the main expirations were quarterly, the so-called triple witching hours, and you had monthly expirations, third Friday of the month. I think, almost 2 decades ago, they added weekly options, the various exchanges. Those have proven very, very popular. And most of the most common stocks, I think the list is up to 600 and some odd names, of the most popular names expire weekly. Along the way, we've started getting thrice weekly expirations, which came about in 2016. And then in spring of last year, they filled in, from Monday, Wednesday, Friday, they filled in Tuesday and Thursday. So we now have a expiration in leading ETFs and indices every day of the week. Now, they've become only, the introduction came largely unnoticed. No one talked about these things until very recently. To me, that the day that really got everybody noticing them was the day after the last Fed meeting, February 2nd, when we set a huge volume record industry-wide. And a lot of that were in options that were expiring that day, Thursday, which we'd never seen anything like that before. So we had a big rally. We had that huge rally that day. Unfortunately, we gave it back, a lot of it back the next day. But so it was seen that the zero-dated options spurred the rally. And I do think to some extent they did, and we could talk about that. But the long and the short of it is zero-dated options are options that expire that day. But let me also remind you that every option expires on its expiration day, and it's zero-dated on that day. So on Friday, we had 600 and some odd options that were zero-dated, not just the usual small amount. So it's evolutionary, not revolutionary.
So, Steve, how are traders leveraging them? Are these purely for speculative purposes, or can you use them to hedge on, for 1 day?
Oh, of course. Remember, options in theory are always a valid hedge. And what I will say here is, if you're a writer of those options, and remember, when you're writing options, your goal is to capture the premium as quickly as the quicker you can capture it, the better. So zero-dated options are essentially pure decay. We know that by the end of the day, there will be zero time premium. The time premium is minimal, when at the open, but by the end of the day, there isn't any. And so if you're a writer, the shorter the option, I used to say when weeklies were around that weeklies were a gift to writers, because instead of having to wait a month to realize your premium, you could do it once a week. Now you can do it quicker, but it's not without risk by any means. But the reason we're all talking about them is because they proved like catnip to speculators. They feature a very low point of entry because you're not paying any time premium. Remember, low price does not mean cheap in the world of investing, but they offer a very low price. And if you guess right, you can get a nice leveraged return for a fixed outlay. Of course, if you guess wrong, they go to zero. Remember, over time, most options expire worthless, meaning the sellers tend to make the money, not the buyers. But if you're in a speculative environment like we have been in, this year, there's a big allure to very short-dated options.
Yeah, and you had mentioned earlier that you could see the impact of zero-dated options on Fed Day. How so?
Well, what we saw on a day like that was, and this is actually a strategy I first wrote about in April of 2021. So this is not new. And think about what the markets were like in April of 2021. They were extraordinarily speculative. And what we would see on these days would be there was natural buying, and traders were right to sense that the market had an upward bias to it. Remember, everybody was in love with the concept of disinflation at the time, which in itself proved to be transitory, but that's an aside. But what the trade would be was, it's logical that if you think the market's going to go up, you're going to buy slightly out of the money call options in short dated options, short dated options. We saw it a lot in SPYs and Qs, which makes a lot of sense, very popular with speculators. And on days like that, what it allowed them to do was, if you bought them in the morning and then waited a little bit, those $1 or $2 out of the money strikes were now at the money. Well, then you could roll them over and try again. And we saw them doing it multiple times over. There was a rare confluence of speculators and investors. And remember, unlike in gambling, which, unfortunately these options appeal a lot to a gambling mentality, not necessarily to an investing or hedging mentality. But if you're gambling on sports or gambling in a casino, no matter how many people bet on one side of the action, it doesn't influence the outcome. If everybody bets on black, it still doesn't make a difference if the roulette wheel comes up red or green. In options trading, or investing in general, if everybody's buying, well, it's going to go up. And so if enough people, sufficient numbers of people were buying calls in the major ETFs that I mentioned, that it actually did push an already buoyant market higher. And once you saw that record option volume, everybody took notice.
And finally, Steve, anything of note with vol Q after a down week? Seems to be relatively muted and staying in the 20s with the sell-off that we saw last week. Today aside, but it seemed to be muted relative to the amount of points that were deducted from the index.
Yeah, I see that in vol Q. I see it in most of the major volatility measures. They definitely picked up a bit last week. People were not oblivious to the fact, but I think this has been a pattern we've seen pretty much since middle of last year. Was, I think, a lot of your major investors, the ones who trade the major index options, such as in the case of vol Q, it's NDX. They tend to be institutional. The institutions have tended to diminish their risks organically. They may have moved, they may be moving to more cash, more fixed income, that sort of thing. And I think are a little less fearful of a sudden swift downside because they're better positioned for it. And so they don't necessarily need to be using measures like vol Q. That doesn't mean it's broken. That doesn't mean that you shouldn't be looking at these trades or using them. But I think that's why we're not seeing tremendous swings like we saw last year, because last year people were caught off sides and they needed vol protection, and that's what they go for. They go for the big indices, the big volatility measures, VIX, vol Q, etc. We don't see that sort of rush right now, which is why the moves in vol Q and the like tend to be a bit more muted. Doesn't mean they're invalid. It doesn't mean they're broken. It just means that the people who trade in these products are not clamoring for the protection that they might offer right now.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.